There's a fascinating disconnect happening in the American economy right now, and it's the kind of thing that makes economists question whether they actually understand how any of this works. On one hand, we've spent the last 2 years implementing policies that should have triggered multiple recessions by now. Massive tariffs that flip-flop every few months, trade wars with our closest allies, public attacks on the independence of the Federal Reserve, threats to default on government debt, immigration crackdowns that left entire industries without workers, regulatory whiplash so severe that businesses genuinely can't plan more than 3 months ahead. On the other hand, GDP growth is running hot. The stock market keeps hitting records. Unemployment is hovering near historic lows. Corporate earnings are beating expectations. By every traditional measure economists use to gauge economic health, things look surprisingly good. Now, you might be thinking this proves the doomsayers were wrong, that all the hand-wringing about chaos and instability was just partisan fear-mongering, that the economy is more resilient than pessimists believed. And you would be catastrophically misunderstanding what's actually happening. Because the question isn't why the economy looks healthy despite the chaos. The question is why we're using measurements designed for normal times to evaluate deeply abnormal conditions. It's like checking someone's pulse and declaring them healthy while ignoring the fact that they're actively bleeding out. The pulse might be strong right now, but that doesn't mean everything's fine. So let's talk about why the economy hasn't collapsed yet. But more importantly, let's talk about why you're asking the wrong question. Before we dive into what's happening now, we need to understand what economic collapse actually looks like. Because here's the thing, very few economic crises happen overnight. They just look like they did if you weren't paying attention. Take the 2008 financial crisis. Everyone remembers Lehman Brothers failing on September 15th, 2008. That's the date that gets marked as when everything went wrong. But the mortgage market had been deteriorating for over a year before that. Bear Stearns had collapsed in March. Housing prices had been falling since 2006. Subprime defaults were spiking throughout 2007. The crisis didn't start in September 2008. That's just when it became impossible to ignore. The foundations had been cracking for years, but as long as the stock market was up and unemployment was low, most people assumed everything was fine, and then suddenly it wasn't. Or look at the dot-com bubble. The Nasdaq peaked in March 2000 and then spent the next 2 years losing 78% of its value. But it wasn't a one-day crash. It was a slow, grinding decline that kept finding new floors to break through. Month after month of surely it can't go lower, followed by it going lower. The point is, economic collapses are usually slow-motion disasters. They're not earthquakes, they're avalanches. And right now, we're on a mountainside listening to the first rumbles and asking, why hasn't the avalanche hit yet? When we should be asking, when did the avalanche start? We're just calling it something else. The most popular explanation for why economic numbers look good is simple. Artificial intelligence spending is papering over everything else. Tech giants are dumping hundreds of billions into AI infrastructure, and that spending shows up as economic growth even if nothing else is working. And look, this explanation isn't wrong exactly. Microsoft, Google, Amazon, and Meta are absolutely engaged in a spending spree that would make even the federal government jealous. Data centers the size of small cities, chip orders that strain global manufacturing capacity, energy contracts that would power entire countries. We're talking about capital expenditure in the range of $250 billion annually. That spending employs people, requires materials, and generates economic activity. It's real money moving through the real economy. According to some estimates, AI-related spending could account for 2 to 2.5 percentage points of GDP growth. That's massive. But here's where this explanation falls apart. If AI spending was the only thing keeping the economy afloat, everything else should be visibly cratering. We'd see negative growth in every other sector. Consumer spending would be collapsing. Business investment outside of tech would be frozen. Employment in traditional industries would be plummeting. And that's not what the data shows. Consumer spending has been reasonably strong across multiple sectors. Business investment, while cautious, hasn't collapsed. Employment has held up in industries that have nothing to do with AI. So yes, AI is part of the story, but it's not the whole story. Something else is keeping the patient alive, and that something else is actually far more concerning than artificial intelligence hype. What's actually happening is more subtle and more dangerous. Let's talk about how GDP is actually calculated, because this is where things get interesting in a deeply uncomfortable way. GDP measures total economic output, but it's a net figure, which means positive things and negative things can cancel each other out. And right now, we're seeing some very creative cancellation happening that makes the top line number look better than the underlying reality. Here's a concrete example. Investment spending is supposed to be one of the growth engines of the economy. And technically, investment spending has been positive, but when you break down what's actually happening, it gets weird. AI infrastructure spending is up massively, adding maybe $80 to $100 billion in investment. That's a big positive number. But at the same time, Businesses have been steadily liquidating their inventories. When a company sells inventory, that gets subtracted from investment to avoid double counting. Over the last year, businesses have burned through roughly $70–90 billion in inventory they stockpiled before the tariff chaos started. So you've got AI spending adding $100 billion, and inventory liquidation subtracting $80 billion, and the net investment figure looks only modestly positive. This matters because inventory liquidation is not a sustainable source of economic activity. Companies can only sell through their stockpiles once. Eventually, they'll need to reorder, but many are delaying that because they have no idea what the tariff situation will look like next quarter. So the investment numbers look okay because two unsustainable trends are canceling each other out. AI companies won't keep increasing spending at this rate forever, and businesses will eventually run out of inventory to sell. When both of those trends end, the investment picture is going to look very different very fast. And this pattern repeats across multiple categories. Strong consumer spending from wealthy households, canceling out weak spending from everyone else. Rising healthcare spending masking weakness in discretionary sectors. Currency depreciation making export numbers look better than they should. The economy hasn't collapsed because the aggregate numbers hide the fact that it's being held up by temporary factors, while the sustainable foundations erode. Consumer spending is always the headline everyone focuses on because it makes up about 70% of GDP. And the headline has been surprisingly positive. Consumer spending growth has remained solid even as confidence surveys show people are deeply pessimistic about the economy. But there's a critical detail that gets buried in those aggregate numbers. Essentially, all of the growth in consumer spending is coming from the top 20% of households by income. The bottom 80%, their spending has been flat or declining in real terms. They're not buying more stuff. They're either buying the same amount while paying higher prices, or they're actually cutting back. The top 20% are spending more for a pretty straightforward reason. Their wealth has increased. Stock portfolios are up, home values are elevated, and they're benefiting from interest income on savings. When you already have money, a high interest environment actually helps you. You can park cash in money market funds earning 5% with zero risk. So wealthy households look at their brokerage statements showing big gains and feel comfortable spending more. They're buying luxury goods, taking expensive vacations, upgrading their homes. That spending shows up in the data as strong consumer demand. Because wealthy household spending is far more volatile than middle-class spending. Middle-class families need to buy groceries and pay rent, whether the economy is good or bad. Wealthy families can decide to delay that luxury car purchase or skip the second vacation home. When the next shock hits, middle-class spending stays relatively steady because it's mostly necessities. But wealthy household spending can contract sharply, and if that's your only growth engine, you've got a problem. We're essentially running the economy on premium fuel, and premium fuel is expensive and scarce. You can do it for a while, but it's not a sustainable model for a mass consumer economy. Now we need to talk about something that's happening quietly in the background while everyone stares at GDP numbers. The dollar has been weakening substantially against most major currencies over the past year. Against a basket of major trading partners' currencies, the dollar is down more than 10%. That's a significant move in currency markets, and it has cascading effects that most people don't notice because they don't regularly convert their money to other currencies. Here's why this matters. When your currency weakens, imports get more expensive and exports get cheaper. That sounds like it might help the trade balance, and technically it does. American goods are suddenly more competitive internationally just because they're priced in a weaker currency, but the United States is the world's largest net importer. We buy far more from other countries than we sell, so when the dollar weakens, the net effect is that stuff gets more expensive for Americans. This is on top of the tariffs, by the way. You're paying more because of tariffs, and then you're also paying more because each dollar buys less of whatever you're importing. It's a double hit that makes the effective price increase worse than either factor alone. The currency weakness also creates an optical illusion in the economic data. When the stock market goes up 10%, but the currency falls 10%, your actual wealth in global purchasing power terms hasn't changed. But if you only look at dollar-denominated accounts, everything looks great. This is particularly relevant for wealthy households. Remember how we said they're driving consumer spending because their portfolios are up? Well, their portfolios are partly up because the dollar is down. They feel wealthier, so they spend more, which shows up as strong consumer demand. But their actual purchasing power for anything imported or internationally priced hasn't increased nearly as much as they think. And here's the truly concerning part. This currency depreciation is happening while we're still the global reserve currency. Other countries are still reluctantly holding dollars and denominating trade in dollars, but they're doing it less enthusiastically than they used to. Central banks are diversifying reserves. Countries are negotiating trade deals in local currencies. The dollar's dominance is eroding slowly, and each percentage point of erosion makes currency volatility more likely. We're losing the stabilization mechanism that used to buffer these moves. The economy hasn't collapsed because we're still living off the accumulated credibility of decades of dollar dominance, but we're spending that credibility faster than we're earning it. While everyone focuses on GDP and unemployment, there are other indicators that are flashing warning signs. They're not the headline numbers, so they get ignored, but they're often more revealing about underlying health. Business formation rates have been declining. Fewer people are starting new companies, which suggests declining confidence in future conditions. The businesses that are starting tend to be in low capital sectors like consulting or e-commerce rather than manufacturing or physical goods production. Corporate debt levels are elevated, and an increasing share of that debt is rated BBB, which is the lowest investment grade rating. That means a lot of companies are one downgrade away from junk status, which would force institutional investors to sell and spike borrowing costs. Credit card delinquencies are rising, particularly among younger borrowers and lower income households. Auto loan defaults are increasing. Buy now, pay later services are seeing higher charge-off rates. These are classic indicators of financial stress spreading through the consumer base. Commercial real estate is still in serious trouble. Office buildings in major cities have vacancy rates that would have been unthinkable 5 years ago. Property values have fallen significantly, which creates problems for the banks that lent against those properties at higher valuations. Manufacturing surveys show declining new orders and increasing inventory to sales ratios, which suggests demand is softening even if it hasn't collapsed yet. None of these individually would trigger alarm bells, but collectively, they paint a picture of an economy under significant stress that's being masked by a few strong headline numbers. It's like a car that starts fine, accelerates fine, but is making weird noises from the engine and the check engine light is on. Sure, it's still driving, but you probably shouldn't be planning a cross-country road trip. So, if all these warning signs are present, why hasn't something broken catastrophically yet? The answer has to do with the nature of complex systems and the unique position of the American economy in the global financial system. Large, complex systems have enormous inertia. They don't turn on a dime. When you're the world's largest economy with the deepest financial markets and the global reserve currency, you can absorb shocks that would devastate smaller economies. Think about it this way. If Argentina implemented the same chaotic policies the US has implemented, international investors would flee immediately. The currency would crash, capital would leave, and the economy would be in crisis within months. But when the United States implements chaotic policies, international investors don't have great alternatives. European growth is weak. China has its own serious problems. Japan has been stagnant for decades. So despite being unhappy about American policy unpredictability, global capital still flows to US assets because the alternatives are worse. This gives us breathing room that other countries don't have. We can make mistakes that would be fatal elsewhere and survive them, at least for a while. But this breathing room isn't infinite. Every chaotic policy decision, every attack on institutional independence, every threat to allies and trading partners, it all erodes trust. And trust is the foundation of a reserve currency. You can think of it like a battery charge. We started with a massive charge built up over decades of being the reliable center of the global financial system. We're now draining that battery faster than we're recharging it. The device still works, but the battery indicator is dropping. The economy hasn't collapsed because we're running on stored charge, but batteries don't give you a warning when they're about to die. They work fine until suddenly they don't. Here's where we need to recalibrate expectations about what collapse actually looks like. Most people imagine economic collapse as something dramatic and obvious. Banks closing, unemployment spiking to 20%, breadlines, maybe some riots. A discrete event that happens on a specific date that you could mark on a calendar. But that's not how modern economies fail. They fail gradually, through a series of deteriorations that each seem manageable in isolation, but compound into something untenable. Japan didn't collapse in 1990. It entered a slow, grinding decline that they're still dealing with 35 years later. Living standards stagnated. Young people stopped believing they'd be better off than their parents. Economic dynamism disappeared, but there was no single crisis moment. The United Kingdom didn't collapse after World War II, but it spent decades in managed decline, gradually losing its status as a global power and accepting a diminished role in the world. That's what economic collapse usually looks like in developed countries, with strong institutions. Not a sudden catastrophic failure, but a slow erosion of prosperity and possibility that happens so gradually people can convince themselves things are fine. And that's what's happening now. The economy hasn't collapsed in the sense of a Great Depression-style calamity, but it is deteriorating in ways that are harder to measure, but just as consequential. Social mobility is declining. Business dynamism is dropping. Real median wages for most workers have been stagnant for years. Wealth inequality is accelerating. Trust in institutions is cratering. Young people are increasingly convinced the system doesn't work for them. These aren't captured in GDP figures. They don't show up in unemployment rates. But they are the substance of economic collapse in the modern era. So why hasn't the economy collapsed yet? The uncomfortable answer is that it has collapsed, or at least it's in the process of collapsing. We're just defining collapse too narrowly. If you're waiting for a 1930s-style depression with soup kitchens and mass unemployment, you might be waiting forever. Modern central banks are pretty good at preventing that kind of acute crisis through monetary intervention. But if collapse means a fundamental erosion of shared prosperity, declining dynamism, increasing fragility, and a gradual loss of the structural advantages that made American economic dominance possible, then collapse is exactly what we're experiencing. The headline numbers look good because we're measuring the wrong things. We're checking vital signs while ignoring that the patient is developing terminal cancer. The pulse is strong right now, but the prognosis is bad. The economy hasn't collapsed in one dramatic moment because that's not how economies this large and complex fail. They fail slowly through accumulated deterioration that each seems manageable until suddenly the cumulative weight becomes unbearable. We're living through a managed decline that's being disguised as normalcy through selective measurement and statistical manipulation. And the fact that most people can't see it happening is precisely what makes it so dangerous, because the time to fix structural problems is before they become crises. And once the crisis hits, your options are limited and painful. We're rapidly approaching the point where we'll have spent so much of our accumulated credibility and institutional advantage that we won't be able to recover what we've lost. The economy hasn't collapsed yet because collapse is a process, not an event. And we're well into that process, whether the headline numbers show it or not. The real question isn't, why hasn't it collapsed? The real question is, at what point do we stop calling this recovery and start calling it what it actually is? So make sure you like and subscribe, because understanding what's actually happening might be the only advantage you have when everyone else is still reading headlines and wondering why reality doesn't match the statistics.